Welcome to the world of savvy investing, where understanding the secrets locked within financial statements can transform you from a novice investor to a market pro. Believe it or not, a staggering 93% of adults admit they struggle to interpret financial reports, missing out on potential wealth-building opportunities. But you're about to leave that statistic behind. In this series, you'll learn not just to read financial statements, but to interpret them with the insight of a seasoned investor. We'll uncover the hidden stories that balance sheets and income statements tell us about a company's past, present, and future. From uncovering subtle red flags to identifying undervalued gold mines, our journey will equip you with the tools to see beyond mere numbers. Each chapter is designed to build your understanding step by step, turning complex concepts into investors' second nature. By the end, you'll not only grasp what the numbers mean but also how to use them to make smart, informed investment decisions. Ready to unlock the language of business and turn knowledge into profit? Let's get started. Chapter 1. Unlocking the Ledger, the Gateway to Genius. When you first open a financial statement, it might look like a maze of numbers, but each line and figure has a story to tell about the company. Think of it as the starting point on your journey to becoming a savvy investor. The balance sheet, for instance, is like a snapshot of the company's financial health at a given moment. It tells you what the company owns and owes. Simple, right? To get more out of the balance sheet, remember it's all about assets, liabilities, and equity. Assets are what the company uses to operate, like cash, inventory, and equipment. Liabilities are what it owes to others, think loans and accounts payable. Equity is what's left over for the shareholders. Understanding this balance can help you gauge how well a company manages its resources. The income statement, another key part of financial statements, shows you the company's performance over a period. It starts with sales revenue and subtracts the costs of doing business, like rent and salaries, to arrive at the net income. This tells you how profitable the company is after all its expenses are paid. A high net income might seem good, but it's important to compare it with previous years to spot trends. Cash flow statements are where things get really interesting. They show the actual cash coming in and going out of the business. Unlike profits, which can be influenced by accounting practices, cash flow gives you the nitty-gritty on the company's liquidity. More cash coming in than going out is a great sign of a healthy company. Did you know that Warren Buffett, one of the greatest investors of all time, considers the ability to read financial statements as one of the most crucial skills in investing? He says, accounting is the language of business, and to invest successfully, you need to understand that language fluently. Chapter 2. Beyond the Numbers, Decoding Company Stories. Reading financial statements is not just about the numbers. It's about understanding what those numbers mean in the broader context of the company's story. Each financial statement can tell you not just how a company is performing now, but how it's likely to perform in the future. For instance, if you see a sudden increase in inventory on the balance sheet without a corresponding increase in sales, it might suggest that the company is facing difficulties selling its products. This could be a red flag indicating larger issues within the market or with the product itself. On the other hand, a consistent increase in cash flow from operations suggests that the company is generating more money from its core business activities. This is a good sign that the business model is sustainable. Remember, a company that can't turn a profit in its main line of business is like a car trying to run without gas. It won't go very far. Also, look at how a company's revenue is growing compared to its debt levels. If debt is growing faster than revenue, it could be a sign that the company is funding growth through debt, which can be risky. A healthy company generally has a good balance between revenue growth and debt. Investing isn't just about picking stocks. It's about understanding the stories behind the stocks. As Peter Lynch, another legendary investor, said, behind every stock is a company. Find out what it's doing. By reading between the lines, you can see not just where a company has been, but where it's going. By mastering these concepts, you can start to see beyond the numbers and understand the true narrative of a company's financial health and prospects. This deeper insight is what separates the amateurs from the pros in the world of investing. Chapter 3. Ratios Revealed, the Rosetta Stone of Investing. Getting to grips with financial ratios is like finding a key to unlock hidden insights about a company's performance. These ratios can help you quickly compare companies of different sizes in different industries. For instance, the price-to-earnings (P/E) ratio tells you how much investors are willing to pay for a dollar of earnings. A high P/E might indicate that the market expects big growth. But there are other, less common ratios that can tell you just as much, if not more. Consider the interest coverage ratio. It shows how easily a company can pay interest on its debt from its earnings. This is crucial because a company that can't cover its interest payments might not be a safe bet. Another powerful tool is the inventory turnover ratio, which shows how often a company sells and replaces its inventory. A high turnover means the company is selling goods quickly, which is usually a good sign. On the flip side, a low turnover might indicate weak sales or excess inventory. Did you know that according to a study, the companies with the highest quartile of return on equity, ROE, outperform others by up to 2% annually? That's a significant margin in investing. ROE tells you how effectively a company is using the money shareholders have invested to generate profits. Chapter 4. Red Flags and Gold Mines. Spotting the Extremes. This chapter is like becoming a detective in the world of finance. Spotting red flags and identifying gold mines in financial statements can significantly impact your investment decisions. One red flag might be sudden changes in accounting policies. If a company changes how it recognizes revenue or expenses, ask why. Such changes can often mask underlying issues. Conversely, spotting a gold mine might involve identifying a company with consistently high free cash flow, FCF. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. A high and growing FCF is a strong indicator of a company's ability to expand, invest, pay dividends, and reduce debt. A classic red flag is the divergence between net income and cash flow from operations. If net income is rising but cash flow is not, it might mean the company's profits are not coming from its core business activities. This discrepancy can sometimes indicate aggressive accounting practices. Remember the case of Enron? Before its collapse, Enron's financial statements were filled with complexities and unusual practices that many investors overlooked. As Warren Buffett advises, be fearful when others are greedy, and greedy when others are fearful. This means being extra cautious when things seem too good to be true. By learning how to spot these extremes, you equip yourself with the ability to sift through potential investments, separating the wheat from the chaff. This skill is invaluable in building a robust investment portfolio. Chapter 5. The Forensic Financier. Auditing like an insider. Think of yourself as a financial detective when you dive into the numbers. Forensic accounting might sound intimidating, but it's really about sharpening your eye to spot the unusual in financial statements. It's the practice of looking for discrepancies that could indicate problems like fraud or manipulation. For instance, if a company's receivables are growing much faster than its sales, that could be a red flag. It might mean the company is recording sales that aren't really happening. One key strategy is to compare the company's financial reports over several periods. Look for sudden changes in financial ratios that don't align with the company's operational narrative. For example, a sudden decrease in the quick ratio could indicate a liquidity problem that wasn't there before. Another important aspect is understanding the footnotes in financial statements. They can contain crucial information about the company's accounting methods, pending lawsuits, or one-time events. These footnotes can often reveal the real story behind the numbers. According to the Association of Certified Fraud Examiners, nearly half of all small businesses experience fraud at some point in their business lifecycle. Knowing this, as an investor, you should always keep an eye out for signs that might indicate dishonesty or financial mismanagement. Chapter 6. From Paper to Profit. Applying your knowledge. Now that you've learned how to read and interpret financial statements, how do you use this knowledge to make money? This chapter focuses on turning theory into action. Start by using what you've learned to screen for potential investments. Look for companies with strong financial health, good cash flow, and sensible debt levels. Then dive deeper into those that meet these criteria. Consider the company's industry and market position. A good company in a declining industry might not be a good investment. Use the economic moat concept here. This term, popularized by Warren Buffett, refers to the ability of a business to maintain competitive advantages over its competitors in order to protect its long-term profits and market share. When you find a potential investment, project its future cash flows and calculate its intrinsic value. If the current market price is below this value, it might be a good buy. Remember, the goal of value investing is to buy $1 worth of value for 50 cents. Keep track of your investments and review their financial statements regularly. Investing isn't just a one-time action, it's a process. As circumstances change, so might the fundamentals of the companies you've invested in. Lastly, always diversify your portfolio. Even the most thorough analysis can't predict every possible outcome. By spreading your investments across different sectors and companies, you reduce the risk of unexpected losses.